check 1 2 3. Volume check 1 2 3. Can I get a volume check? Volume check. One, two, three, 1 2 3. This is episode 3 for QQQ After the Bell. Episode 3, it is a recap of QQQ Before the Bell, episode 3, which was published for Wednesday, March 25th, 2026. Report mapped out 3 scenarios before the open of Wednesday, provided where we stand, broader, larger term, daily, year-to-date structure and the context. The goal of the recap overall is to help walk through how this price action traded relative to the report and show that the framework for how price action will most likely repeat patterns based on the prior day's structure. That's the whole point of the framework, is to provide individuals who are interested in trading the NASDAQ, the QQQ, providing them a framework to consistently have reproducible systems of acknowledging the points of support and resistance and knowing where to be hedging. Where are the edges of the market's natural ebb and flow from the buyers and sellers shaking out the volatility? It's natural, especially in the Trump administration when there's constant news. But providing Tuesday's recap, I think it's better to just get to the pivots of resistance, 584.93 cents. It was the 50% retracement of Tuesday's range, the single most important level of the trading day. My projection for what Wednesday's most important day would be. We'll see how we actually traded in a moment. From the support, again, it's either a point of support or resistance depending on how the price action structure holds. If we're stuck beneath it, it can be a point of upward resistance. If we're holding above it, bouncing off of it, it's a point of structural support. So understanding how we're opening relative to it will provide the context and validate what scenario we have. How the price opened relative to 584.93 cents, our pivot, is going to determine what type of scenario are we currently experiencing. The bull reclaim, a bear rejection, or consolidation. There's more nuance than simply 3 scenarios for the means of providing a concise 5-minute read as a pre-market report preparation. I find that the 3 scenarios suffices. Time is a variable that is a major influence that I'm starting to attempt to recognize. And if it holds, the afternoon path higher remains open. If it fails, a retracement toward here, 584.22 or 583.13 into the close is more likely outcome. Upwards targets, the 586, 586 and a half, 587, 588 basically, and then the upward extensions of 590, 592 for the bull reclaim scenario. This was the upside extension target that I published in the report. I provided it as a band of $2 moving forward. I'm going to work on it being just a $1 band. It's not an exact price level, but an area. And we'll see how price traded relative to these targets. The bear scenario, rejection of that pivot, the downside targets, the consolidation where neither side fully commits and you have compression within the prior day's, Tuesday's intraday range. That is not what we saw today. Instead, we saw something much more interesting than consolidation. The volatility estimated range was to be $5 to $7. If we do see expansion on Wednesday, we were looking for a $9 to $10 move. Tuesday's range of $6 compressed relative to Monday's range of $9.10. So you can see compression. There's a slight curling on the daily, but that's a very, very early signal that should not be any cause for bullishness. Overall, the default lean from the session summary here was more bearish than bullish. We are year to date down 5.8% on the NASDAQ, and the descending trend line, I should say, the descending trend line was capping every rally we've experienced ever since the all-time high. And this is the QQQ Before the Bell episode 3 report that was published before the market opens. It is released to inboxes by 7:30 a.m. I plan today to upload it before after this live is done. I will send out, I'll finalize and publish QQQ Before the Bell episode 4, which will prepare for Thursday, March 26, 2026. However, this recording, this live stream, is more so to just focus on the how did price actually trade. So when you look at the structure on the daily, I think it's good to go from a higher time frame down to the smaller time frames. And the daily, you can see here from the close to the open, we have a gap up. Gap up of $5.16, 0.88%. You're already seeing a $5 move overnight. At the highs, the market was up 1.27, 1.25%, $7.39. You closed the day up 0.66%. Pre-market right now is a little lower than where we closed, about 80 cents, 70 cents lower than where we closed. We held the wick here, so the gap didn't fully fill. Very quickly, just showing the gap from the close here to Wednesday's gap up open. You can see you fill 50% of the gap. You test 61.8% of a gap fill before buyers push price back up. Buyers were defending the gap fill, bouncing, holding defense, trying to hold defense. Sellers making a quick move lower, but buyers still defending 50% of the overnight gap on the NASDAQ ETF QQQ. This is one form of technical analysis. One form of technical analysis is looking at the overnight gaps when they do form. What I'm focusing on is how price is trading in the previous intraday and how price today opens relative to those levels. So here, you can very clearly see from where we closed to where we open, market gapped up. I must have not had the right price when I clicked it last time. I must have clicked the high. It's basically 0.9, 0.8% gap up. 0.9%, $5.25, $5.24. And you're opening above the high, you're trying to break higher. The retracement lower is getting a long bottom wick on the 5-minute chart that signals that the buyers are stepping in off that low of day initially. You're opening above yesterday's high. What scenario is this? If you're above 584, you're thinking bull structure, targeting the upside points. You opened above all those. 590, 592 is the extension communicated. Here you can see opening price 589, 14 cents. high of day 591.37 almost breaking to the 592 upside target that was communicated. And instead you see the long top wick profit taking open of the next 5-minute candlestick. Buyers try to retest the high of day. They hold a lower high. A lower high. Sellers close the price of this 5-minute candlestick below the prior candlestick's low and below its open. This candlestick is closing into the lows. Sellers are signaling that they're present and price moves lower. But price never moves in one simple direction. Instead, the upside extension is essentially achieved. The range of 590, 592 is achieved with this high of day. After this upside target is achieved, we see the retracement down, and the point of support really 585.64. This is the top of the golden zone. We weren't testing the prior day's midpoint, 584.93. We were holding above the top of the golden zone. This key level, these areas previously communicated, because it's just where price is likely going to go next. Coming on a gap up, coming back down to these points and seeing the bottom wick, seeing the defense of this, it's very interesting to see how the market can provide almost a 1% intraday range after it's already had a nearly 1%, a 0.88, a 0.9% overnight gap up. So the way the market's moving is very interesting. This volatility and the sentiment is definitely shifting due to the overall geopolitical tensions. But I think the 10-minute would be better to focus on. Better to show everything. So you're closing just beneath yesterday's high of day. There's confliction. You're opening above yesterday's highs. You're testing above. You're rejecting. There's a loop and tag here. And I would think this is distribution. This is the buyers and sellers battling it out, and the sellers are overcoming the buyers, pushing price lower. Institutions are layering their sell orders and filling out the highs and profit taking on the moves lower. How I interpret it. So the gap open, not a full fill, 50% of that gap filled. The high of day here, 8 minutes after the open, basically was when high of day was made. Lower highs held, lower highs held. So the bearish sentiment that was communicated in the report, a lean of bearish sentiment, is appropriate. The timing of it is what determines success or failure. Trading is 85% price action interpretation, 15% technical analysis, 100% of timing. Timing determines success 100% of the time. So you need to be hedging the bearish sentiment at the right points, at the lower high hold, when you're rolling back lower with 2 hours left in the trading day, retesting the prior points of support. The original low a day, this area here, you're back testing after you originally defended that gap up from the close to the open. That 50% is right here. Kind of hard to see that, but it's basically where these candles are overlapping the 23.6 of Tuesday's range. So the overall volatility in a tighter range. You were opening above yesterday's range, but you weren't fully retracing. I would say this is a controlled sell. This is a market that is attempting to digest the geopolitical tensions, is trying to balance and determine, is sentiment shifting from its previous bearish lean towards a more neutral bullish stance, or is sentiment remaining bearish and the buyers are continuing? There's a lower high sentiment here that is to a degree, the lower highs versus the lower high versus this right here is Monday's high. Monday's trading day, Tuesdays, and this is Wednesday. So it's still the lower highs and the bearish sentiment remains. So I wonder if the live stream can pick up the police siren in the background. That is very loud. Live streaming on a busy street. Very good. Very good. Overall, we had the gap up, high a day set within the first 10-minute candlestick. Here you can see the top wicks. I should have muted the mic. I swear they turned the siren off within 2 seconds of passing the house. They passed my apartment immediately. Sirens, you don't need them anymore. You're at your destination, apparently. Okay. Where was I? The chronological, I'm trying to explain this report. Its purpose is to prepare traders of the QQQ, the NASDAQ ETF, prepare you for the potential points of support and resistance. Upside target 590, 592. We had a high a day, 591.37 cents. From there, we only held lower highs, and you had a low a day. You made a slight new low a day, and then you spent a good time consolidating before lower highs continued to hold. Long top wick on that candlestick there. You opened, broke two highs, broke and closed into the low. You consolidated. The buyers were unable to break and hold higher points and invalidate the lower highs. The lower highs held, so lower lows are tested. Price rolled lower, puts profited, and that's the real simple story. You closed beneath yesterday's high of day. It seems very calculated. It seems very controlled. You're bouncing right off of the defense of 50% of the gap fill and closing just below yesterday's high. I don't think that's a coincidence. I think it's a very calculated pin for the NASDAQ in the middle of the week in one of the more volatile times of the year. Seasonality report has been published on the Substack. You can read it for free. Beta heuristics on Substack here. It's somewhere. I'm loving how much more content I'm putting out, and I have to actually scroll a while to get to the seasonality report. But you can come to this report and read the details and understand why it is that the spring months typically have more volume than, or more range. There was a correlation with increased volume, but the dominant trend is a larger range percent, taking the high minus the low divided by the open of every trading day and analyzing that. The other thing I wanted to note is I cannot every single day get out a midday update. However, when I can, I believe it's worth noting. The whole point of this midday update is how is price trading relative to the QQQ before the bell, episode 3. Is price respecting the bear scenario, the consolidation scenario? No, it is the bull scenario. One of the scenarios has to be accurate. Figuring out which scenario it is helps provide edge. What points of support and resistance should you be looking for? And where things stand, I was just trying to recognize or communicate that you need to defend the structure. That there's risk if you can't sustain, there's a risk of being in a fade, that the market would retrace backwards and maybe look to retest that points of prior support. You coming back to the low a day. And we never got the Relative to when the report was published, yes, there was a slight new low of day, but more so trying to anticipate a test within the gap maybe being filled, but looking for the prior day's midpoint, that point of being a pivot. Is that pivot going to come into play? It did not today. And the midday updates, I will not promise to have these midday updates every single trading day. When I can get them in between the classes I teach, I will. However, it's not my day job. So the midday updates, if there's a trader that is finding value off this, if you find value from this, I would appreciate a subscription, a follow. The Substack is free to subscribe to. YouTube is free to subscribe to. And it just helps promote me on the algorithm, and it pushes me to other accounts that may be interested in investing or in trading. So it's a really interesting trading day, how we opened above the high, closed below the high of Tuesday, and the sentiment, despite opening above yesterday's high, was not predominantly bullish. There were bounces, but there was no higher low structure that held to break two higher highs. The high day was set 938, and it's critical to recognize when the high of day is set, how is structure forming relative to that high of day. You're just seeing these long top wicks forming. It's just complete rejection. So the lower highs that formed after higher day, it's price action signaling. Price action tells the trader what direction it's going in. The trader simply has to remove their ego and just react to what the structure of price action, the sentiment of that structure, what it's telling it. Each failed attempt to make a new high of day is a signal that the sellers are defending the points of resistance, the bull extensions that were communicated in the report, and defending at points of resistance. This isn't a buying opportunity you want to be chasing. This is a shorting opportunity that you short with a high probability setup conviction. You're above yesterday's high of day. You're above the U.S. market open price. And the idea is that you oscillate the U.S. market open price. You want to be long the price when you're below the open. You want to be short when you are above the open and oscillate it in a range-bound market. We've been seeing more range-bound consolidation than we have been seeing strong trending moves. From the close to the open, you have a gap down, continued move lower. This occurred on the 20th. Then you have Monday. From Friday to Monday, we've just been trading sideways. From the close to the high here, the range is 2.24%. At most, we've been in a 2.24% range over these last 3 trading days here. And that's just compression. Compression leads to expansion. I will not claim to know when we expand or what direction we will expand in. We will eventually expand. The expansion is being baked into the price. And we may need to make a slight new low before we can break higher. We may need to break a little higher before we can make real new lows. Anything is possible. Having the flexibility to be dynamic with the market instead of rigid and holding a bias, that is what provides edge to traders. Because a frigid, stale mentality that is not dynamic cannot survive. The market can be illogical, irrational, experience extreme exuberance longer than a trader can understand it and properly hedge if their bias blinds them, if their greed blinds their vision they cannot successfully trade. So the whole point of the report is to help prepare traders. The midday update is just to warn that if the lower highs versus high of day continue to hold, be prepared for a fade. And that's exactly what you see. Closing below the open on the daily, you close well below the highs, obviously. You closed just beneath, what is this price level here? 588. 588 was Monday's close. It seems as though it was the high here. The high was 587 and 93 cents, 7 cents below. And then the close today was, just below that. So it's clearly compressing. And the midday update was trying to warn that, even on the higher time frames, it's still bearish leaning. It's lower highs. Be prepared for a potential fade of lower highs fading into lower lows or just consolidating range bound. The analytical calls I'm providing, do I have to call myself Babe Ruth and just start pointing and smacking home runs out here? Do I have to show the puts that I trade? Do I have to show that I'm making more than 100% on the trades on the 0 DTEs? Do I have to do that? I don't want to be I made over 100% on the trade guru. The analytics, the predictions of potential levels of support and resistance are accurate. It's free edge. It's free alpha if you trade it without a bias. So the analytical calls can be accurate without any engagement on Substack. And that's completely okay with me because my validation is not external from other people, it's internally. This is all just a public record. This is all just the explanation for how. Anyone can be a day trader or an investor. Everyone should be an investor. Everyone should invest and have a portfolio because your dollar will be printed to death. So have investments that are denominated in dollars that inflate in price when the dollar loses its value. It's inevitable. You print and print indefinitely, quantitative easing. Most people don't understand how fractional reserve banking works or that we have quantitative easing. When you understand these things, it's not a question of can you handle the risk of investing. The question is, how much is the risk if you do not invest? What is the max or the minimum amount of capital at a risk-free rate, whatever amount you could afford to risk, invested over the span of years, decades, compounding, compound interest, having dividends reinvest into stocks? This is the pathway to financial freedom, financial independence. That's the whole point of this channel, to provide frameworks that make markets make sense for the average individual so they can hedge themselves appropriately, profit whenever there's a high probability setup to deploy capital where the risk reward makes sense. You grow your capital, you preserve capital, you hedge appropriately. It's not going all in on 0 DTEs and trying to become a millionaire on one trade. That is a very quick way to destroy a portfolio. Full porting a port is not the move, chat. It's not the move. The move is compound gains, let it work slowly, reinvest dividends, and play the long game. Time in the market is way more important than timing the market. Don't time the top and bottom. Sit in the market for the long run. That is my unprofessional opinion. I am not a financial advisor. None of this is financial advice. This is my education to my future self as a reminder. It's just for education, entertainment purposes. It's not financial advice. I'm not telling you to buy anything in particular. The whole point of the report is to help the average person trade. It provides me I'm already doing that kind of analysis of the markets. Now I'm just trying to keep a public record So the report's accuracy from an analytical perspective, the points of support and resistance, I will do my best to maintain this accuracy. And if you appreciate this work, please feel free to like, comment, subscribe on all the platforms. Substack is where you'll find these reports. And I am Chris McVitie. I am the author of Beta Heuristics on Substack, where you'll find the QQQ before the Bell Report. Episode 3 was published today. I'll also publish episode 4 once this live stream is over. Probably get some of the clips put on the YouTube channel as well. Feel free to like, comment, subscribe all over. It helps with the algorithms, chat. I really appreciate your involvement. Real quickly, the S&P 500 index, the daily chart, obviously, it is mirroring the NASDAQ. The S&P 500 and the NASDAQ, they move in tandem. It's not a one-to-one correlation, but they share a large portion of the same components. Amazon, Apple, Google, Meta, you get it. So we're still in a downtrend. As long as we're above 6490, 6500, I'm starting to shift a little more neutral, a little more bullish, but the structure needs to hold. It's not, okay, now I'm in puts with, it's not suddenly bullish sentiment. Now I'm in calls that are 0 DTE, 1 DTE, a week to expiry, or a month to expiry. It's not to do that. It's to understand that you're shifting the bias to be more open-minded. It's been bearish. We're starting to see, when we start to see the green candlesticks, price action starts to break higher. When we start to see the red candlesticks, price action starts to trend lower. That's for a reason. The candlesticks have code that is dynamic based on the open close of the candlesticks, and it's shifting to show the short-term trend. In the short-term trend here, it shifted bullish one day, next day gapped down and continued lower. So one single trading day is not sufficient to change the bias. It's one data point that is signaling the open-mindedness. We're dynamic. We are not rigid in a box. Think outside the box, the matrix. Break out of it. The weekly sitting right inside based on the open to the close. How is that? That the S&P 500 cash index closed 65.91, the 50% of the weekly range. The full weekly range, you can see, is 66.13, but I don't think the full range is as important as the open to the close. You can see that price is respecting that on the weekly. We're within the prior weekly. How this week trades how this week trades relative to the prior week's range will provide more context and insight moving forward. I'm really excited to just keep this content rolling because the market will provide opportunities. It's going to get more volatile. It's gonna get fun, folks. Trust me. This is only the beginning. It's actually the end of the beginning and the start of something very different. The escalations in the Middle East, it's just Act 1. The world stage, it's setting up for much more fun work, much more fun volatility, I should say, for the traders. The investors will go for a roller coaster ride. The world stage is preparing. All the world's actors are lining themselves up. There's a lot in store, folks. The S&P 500 cash index is consolidating within its prior weekly candlestick, and based on how the current weekly candle closes on Friday, relative to the prior week will provide a lot of context. I'll update you by the end of Friday. Bitcoin on the weekly, can see here that relative to this range, we're holding the higher lows. We're still stuck within this first week of February. Again, the unfilled gap remains. But from the close to the open, Bitcoin gapped down that 8% from the close of January to the start of February. And year to date, red on Bitcoin. So we opened year to date. The opening price on Thinkorswim is not the same as on let's see here. Year to date. I think, did this get updated? This looks so different than it used to. Screw it. Below 71, below 70,000 is the area in which Bitcoin enters bear market territory, currently consolidating the hold of higher lows, trying to shift the short-term bullish. You can see green candlesticks. We're trying to get the short-term to break higher, but that long top wick, there's sellers profit taking, rejecting the highs of the day. Don't love to see that as a bull in the crypto community. So the consolidation here can continue indefinitely. We are back in this area where we had spent time previously hanging out, consolidating, compressing, compression before expansion. And so far, 1, 2, 3, 4, 5, 6. This is the 7th week. If not this week, it may not be until the 11th week. I don't make the rules. I don't make the rules, chat. And let me know your thoughts in the comment section down below. The live stream chat is probably quiet as a church mouse. I can't really ask questions or be asked questions if there's no one there. I'm not botting this. I am your least favorite fake YouTuber with your most accurate analytical read of the NASDAQ and everything financial markets related. The last thing before I cut the stream here, possibly the most important thing to discuss that I've put on the back burner, is interest rates, everyone's favorite topic. The 10-year yield is rising. It's trying to reject 4.4%. The higher interest rates are, the worse the situation for equities. Equities, they bloom under low interest rate environments. Technology sector, technology companies that drive the main catalyst for the growth in the stock market, these are going to benefit from low interest rates that incentivizes borrowing and investment into tech, reinvestment into their businesses and so forth. You can borrow at low interest rates and invest into technology at an easier rate. So when rates are rising, it threatens also the national debt, the rate at which interest is accruing on the US national debt. So there's a confluence of macroeconomic levers that are at play. And the main reason is In the short term, we saw the Federal Reserve maintain interest rates unchanged. That is the second consecutive meeting by the Fed where interest rates were not changed. This coincided, maintaining interest rates steady coincided with long-term interest rate projections having one less interest rate cut in, I believe, 2027 or 2028, one less interest rate cut, which the market is forward thinking. And as the interest rates are rising as a result, we also saw gold decline. There's a lot of volatility in the markets and a rush to safe haven assets such as the trade-weighted dollar or the DXY. Trade-weighted dollar here, rallying off of the lows here of 2026, trying to break higher, just below 100 for the trade-weighted dollar. I'm more interested and focused on yields. Are we seeing the Japanese 10-year yield rise? Is the yen carry trade further unwinding? As the 10-year yield in Japan rises, the borrowing costs of yen rise. Historically, cheap yen, when interest rates are low, almost negative, real yields, interest rates subtracted by the inflation rate, real yields being negative, then it's smart to borrow cheap yen, invest that cheap yen in risk-on assets, and then when you need to cover the borrowing costs, you sell those risk-on assets. That is the yen carry trade, as interest rates have risen in Japan to rates not seen since, I think, almost 2000. It's raised borrowing costs, forcing yen borrowers to sell the risk-on assets they invested in with the cheap yen. They sell those assets, such as Bitcoin, to shore up the capital and cover the elevated borrowing costs. Now, it's been a while since this spike in the yields in Japan's bond market. It's stabilized. I guess 2%, 2.2% is the new normal for the Japanese 10-year yield. 4.3, 4.4, 4.2% for the 10-year yield in the US. So as those interest rates rise, we would likely see declines in the equity prices. It's not a one-to-one causation. It is a correlation to a degree. And if you have any thoughts on this, feel free to let me know your thoughts in the comment section down below on the debt market, on the whole U.S. debt bubble, the national debt problem that the current generation seems prepared to kick the can down the road about, that leaves the future generations holding a flaming bag of dog excrement. I'd rather not hold that bag. Rather drop it off at a person's porch, but in Minecraft. Anyway, chat, the Bitcoin is holding the key level, 65,180. Unless it's below that level, I am no longer bearish in the short term. I am neutral. Above 74, 75,000, I shift neutral bullish. Above 80,000, I shift bullish, anticipating that 80,000 will then very quickly get to 84,000 because of the unfilled gap from the close of January to the start of February. And that trade does not necessarily require a cryptocurrency account to profit from it. A Bitcoin proxy such as MARA may be worth the risk, understanding that this is testing points of support that have not been seen since back here in 2023. So MARA, a Peter Thiel project that is a Bitcoin miner, Bitcoin treasury, a proxy for Bitcoin. They're expanding outside of Bitcoin into the data storage field as well. I have to do more research on this company. I will never recommend that you buy this company's shares. I will not say that you should sell, buy, or do anything with this company. I am simply commenting on this company as a way to have a hedge that is correlated to the cryptocurrency markets without actually opening a cryptocurrency account. You can experience the cryptocurrency volatility without going to Coinbase via Bitcoin proxies. You can try Bitcoin ETFs. I am not your financial advisor. I am not a financial advisor. This has not been financial advice. Please do not misconstrue it as such. The idea is if you are open to hedging your portfolio with MARA for calls when Bitcoin is expected to go up, puts when you think Bitcoin is expected to go down, it is a proxy for Bitcoin you can hedge with. Plain and simple. I'll never tell you to buy or sell it. I won't share my personal trades on it. I am not a shareholder of it currently. I would like to be a shareholder in the future. In the long run, I am a long-term bull on Bitcoin simply because the US dollar is a much worse store of value. Functions of money: store of value, unit of account, medium of exchange. Dollar is better medium of exchange currently. Store of value, it's not even close. The purchasing power parity of the dollar only declines year after year. Purchasing power declines. It requires more dollars. The dollar has less value. It's a cheaper dollar. It buys a smaller basket of goods with the same amount of dollars. Can of tomato soup in 1970 compared to today. The cost to create the can of soup, to transport it to the consumer, has not increased rapidly to offset the cost from being 25 cents to now $1.80, $2 a can. So understanding that Bitcoin is a superior store of value, it makes an investor open-minded, not to 100% full port Bitcoin. No, hedging a portion, 1%, 2%, at most 5% is what I've heard JP Morgan or the institutional side that's becoming more accepting of Bitcoin when their clients request exposure to Bitcoin and inquire about the percent of portfolio allocation into Bitcoin, the recommendation is at the most 5%. Because at 5%, when Bitcoin has extreme upside volatility, that 5% is a significant portion of the portfolio to see a nice return on the investment. But if Bitcoin stays stagnant or declines in price, that 5% allocation does not decimate the portfolio. It's proper risk management based on risk aversion, the risk profile, how close to retirement is an individual. Closer to retirement, the less risky, the more safe the investments, more debt-denominated investments, money market funds, treasuries, something that has a guaranteed risk-free rate of return. It's not guaranteed risk-free rate. The US government can default. If that happens, God help the USA. But let me know in the comment section down below if you think the United States will ever default on its debt, if you think Bitcoin is a better store of value than the US dollar, if you think the US dollar is superior to Bitcoin, if you think Bitcoin is a proxy or a fake product created by the Central Intelligence Agency to introduce central bank digital currencies to the mass public and to shift the Overton window towards programmable money. If you think that's possible, let me know in the comment section down below. If you like this content, remember to like, comment, subscribe. It helps with the algorithm as I flub the words. I am Chris McVitie. This is Beta Heuristics. Please remember to like, comment, and subscribe. It truly helps with the algorithms, and I greatly appreciate your support for the channel. Until the next recording, stay green.